Good afternoon and a very warm welcome to everyone present at our annual earnings call. I hope you and your family and colleagues are safe and taking care of yourself in these difficult times. I am Samir Hiremat, CEO and Joint Managing Director, and along with me I have Anish Twadi, President Business Development and Strategy, Kuldeep Jain, Financial Controller, and Strategic Growth Advisor, our Investor Relations Advisor. Let me start by giving the updates on our current state of operations amid the COVID-19 situation. Post the announcement of the lockdown by Government of India on 25th of March 2020, we had shut down our operations safely at all our facilities. Being a part of the essential services industry, after getting all the necessary permissions from the respective government authorities, we were able to restart our operations from 5th April 2020. Post the commencement and restart of operations, it took us between 10 to 15 days to normalize the operations and to start producing in a safe manner. The capacity utilization for the month of April has been low. However, the utilization has improved to around 60% in May, and currently in the month of June, we are operating at around 80% utilization across our manufacturing plants. With the partial easing of lockdown restrictions, we currently have approximately 75 to 80% manpower working at our manufacturing units. As the safety of our employees is paramount, we have taken all the necessary precautions advised by the Government of India and the WHO. During the COVID-19 lockdown, we have implemented several cost rationalization and efficiency improvement measures across the company. These include increasing our domestic sourcing of key raw materials, as well as investing in increasing automation, mechanization, and implementing Industry 4.0 initiatives, which will lead to improvement in operations efficiencies going forward. On a positive note, we are receiving several inquiries from customers who are planning to de-risk their supply chain. Our business continues to be robust, with no major impact on demand for our products. We would like to state that there has been no cancellation of any orders, and we continue to be optimistic on the long-term prospect of both our businesses. On the raw material supply side, we had initially experienced several logistical issues due to restriction in movement of goods, which has been resolved to a large extent. Having said that, we are still facing few instances of delay and non-availability of some raw materials, and we are taking necessary action to mitigate this risk. We are also working towards de-risking our supply chain by developing domestic sources for all our raw materials wherever possible. Now moving on to the financial performance. Our revenue for FY20 is 1,507 crores as compared to 1,590 crores last year. If we adjust the same for impact of lockdown in Q4 FY20 and the impact of production disruption in Q2 of the last year, the revenue would have been similar to FY19. The EBITDA for FY20 is 273 crores as compared to 298 crores last year. We were able to maintain our EBITDA margins above 18% for FY20. Our PBT for FY20 is rupees 142 crores as compared to rupees 149 crores. PBT for FY20 is before adjustment of exceptional expenses of rupees 15.4 crores. The net profit for the year before exceptional item is rupees 96 crores and rupees 84 crores after adjusting for exceptional expenses as compared to rupees 103 crores in FY19. The crop protection division recorded a revenue of 620 crores for FY20 as compared to rupees 650 crores in FY19. This division has an EBIT of rupees 100 crores in FY20 as compared to rupees 112 crores in FY19. The pharmaceutical division recorded a revenue of rupees 887 crores for FY20 as compared to rupees 939 crores in FY19. The EBIT for FY20 for pharmaceutical division is rupees 128 crores, which was similar to the FY19 EBIT of rupees 129 crores. The additional capacity at Bangalore, which came on stream on the second half of the last financial year, also started contributing to revenues. Both our sites at Bangalore and Panoli also got recertified by the US FDA last year. During the year, we have filed 3 new drug master files for our generic business. On the contract manufacturing side, we have several products in various stages of development, which will fuel our growth for the next coming years. We have successfully developed the API for Favipiravir at pilot scale and are currently supplying test quantities to clients. Favipiravir is currently in medical trials for the treatment of COVID-19, and clinical trials are currently running all across the world. We are currently scaling up the product and expect to commercialize the product by September, October of this year. There is still a regulatory process that has to go through, and there is still early to gauge the demand and the revenue potential as of now. Balance sheet. During the year, we have reduced our gross debt by rupees 16 crores from rupees 661 crores on March 31st, 2019 to 645 crores as on March 31st, 2020. Our net debt has also come down from 629 crores on March 31st, 2019 to 581 crores on March 31st, 2020, which is a reduction of 48 crores. Our debt equity ratio has improved from 0.79 on March 31st, 2019 to 0.69 on March 31st, 2020. We have met all our debt obligations during the year, and even during the COVID-19 pandemic, we have not opted for the moratorium option and are confident of meeting all our future obligations. We have seen improvement on the working capital front as well. Our net working capital days as on 31st March 2020 is 110 days as compared to 120 days as on 31st March 2019, which translates into an improvement of 47 crore rupees. We are continuing with our capex plans across both the segments. During the COVID-19 lockdown, the construction activity was completely stopped. However, with the reduction of lockdown currently, we will be resuming construction activities shortly at our sites. Currently, the availability of skilled manpower has been a challenge due to the ongoing pandemic, and we are discussing with various contractors to provide skilled manpower on a long-term basis. Due to the pandemic, the commissioning timelines will be pushed back by a few months. As per the current estimates, we expect to complete the capex program by end of FY21. As of 31st March 2020, out of the total capex of 300 crores, we have already spent 158 crores, and the balance would be spent in this financial year. As our current capex is towards multi-product plants, which provide us with the flexibility to manufacture various multiple products, we are confident of improving our return on capital employed going forward. The net cash inflow from operating activities before exceptional items is rupees 219 crores for FY20 as compared to rupees 115 crores for FY19. Adjusting for exceptional items, the net cash inflow from operating activities for FY20 is rupees 204 crores. Free cash flow generated for the year was rupees 61 crores compared to a negative free cash flow of rupees 12 crores last year. In conclusion, I would like to apprise you on 2 important developments. Hikal has been recertified for the second consecutive year as part of the Great Places to Work. Last year, we were in the top 100 companies in India, and this year we have been ranked in the top 50 companies in India. Secondly, in line with our core values, we have supported the central, state and local governments and contributed over rupees 2.5 crores as towards fighting COVID-19. A significant part of this expenditure has gone to distribution of food, masks and medical equipment to those in need. With this, we can now open the floor to questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from Sundaram Mutual Fund. Please go ahead.
Yeah. So my question is on this crop protection business. I mean, if I look at all other companies reporting numbers, whether they are directly into agri inputs or in contract manufacturing, most of the companies have given a very good outlook both for the domestic and export. I mean, if I look at our numbers for the fourth quarter, it looks like it has been fairly kind of flattish, and of course lower on a year-on-year basis. Can you give some color on this? I mean, when can we expect the traction to happen over here? What is the kind of growth that we are seeing in the domestic and export? And if you can give some color on how much do we derive from the domestic and how much do we derive from the export on an annual basis?
Yeah. So the reason for the crop protection business being flattish for this year was because there was some inventory correction from some of our major customers from the last financial year. This year we expect that inventory correction to be over going forward. Exports are a large part of our business on the crop protection business. It's almost 80% of our revenues come from exports. About 20% come from the domestic business. And we are expecting the growth to start coming in from this year and from next year onwards. Mostly from next year onwards, because this year there's a lot of uncertainty due to COVID, and depending on when the plants can get to full capacities. But we expect the growth to start resuming from the next financial year.
And sir, with a small capacity free-up that happened last year, and I think you had also mentioned that this year, by the end of this year, this 300 crore capex is expected to complete, and probably that will come in FY22. Currently, what will be the utilization across both the divisions, and with the new capacities coming in, I mean, how do we see the traction, and what can be the kind of sales from the current capacity and the new capacity?
But currently the plants, once we get back to full operations, are running at about 80-85% utilization. That's the current capacity utilization right now. The capex is expected to be completed. There's been a delay, as you know, because of the COVID, last 2-3 months. Will get completed by end of this financial year. And we expect the revenues to start rolling in from FY22, and FY23 will be the full impact on the revenues.
And here we can see an asset turn of about 1.5 times of this 300 crore.
About 1.5 times.
About 1.5 times.
Yeah.
And just one final question from my side is, if I look at, especially the pharmaceutical part of the business, I mean, the broad, we have a legacy portfolio, and a lot of the products that we have filed for are in this diabetic, new generation portfolio. I mean, but if I look at primarily the margins on an overall basis, the gross margins, I mean, it doesn't seem like the contribution from the new generation has actually started kicking in. Can you give some color with respect to when we can start expecting, the new generation molecules kicking in, and when the benefits can actually start coming through from that side?
Well, the products are being launched. I mean, we filed a few DMFs last year, and we expected the benefits to start coming in from FY22-23 onwards. Some will come this year, but there'll be a big jump, 22-23 onwards when the products get launched.
Okay, but we have launched some products, right, into this from the new generation.
Yes, but they're small quantities, Yeah. So it takes time.
Okay.
But your question. Sorry. Go ahead.
Yeah. So what I'm trying to understand is, should we see, because if I look at the, currently the majority of the products, I mean, revenues are basically coming from, legacy products like gabapentin, etc. I mean, over the next 2 to 3 years, should we start expecting that the legacy molecules will start contributing much lesser, and there should be a visible contribution from this, new generation molecule?
That's correct. I mean, legacy will become a less minority in the next 3 to 4 years. But the new products will take over as a percentage of total sales.
Okay, the margin should also be significantly better for the new generation, I would add.
For sure.
And any, clarity on, the Savvy Pairware, if I look at this opportunity, I mean,
Yes.
what is the kind of, one is, when you're looking at India and emerging markets over here, if you can give some color with respect to what is the kind of volumes that one can look at and what is the kind of opportunity, whether it will be meaningful or whether it will be insignificant, because given that we have developed this product in a record time. So that should be quite helpful, given that this opportunity is happening primarily by the third or fourth quarter.
See, the clinical trials are currently underway. I mean, they're still underway. I mean, we need to wait and watch, and we should have a better idea in the next couple of months. I think it's too early to make any comments on the potential right now. There's a lot of interest. A lot of people are contacting us. We are sampling many customers, but everyone's waiting for the clinical trial results to come out, which is currently underway in many countries.
Thanks a lot, Alexander.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Anand Bhavnani from Unifi Capital. Please go ahead.
Thank you for the opportunity. Sir, my first question is about the capacity plans for the new CapEx. So how much of the new CapEx would be absorbed by existing set of products, and how much of it is kind of earmarked for newer products? If you can give us a broad split.
Well, it's existing products is about 40 to 50%, and new products is the balance. We also have to keep some free capacity in the existing. We can't fill up our plants fully because we're also looking at getting kind of contract manufacturing opportunities that are coming along. It's a combination, yeah.
Sure. And sir, you mentioned FY23 would be the first year of this capex getting fully commercial. So in our overall planning, what is like we are expecting it to be fully utilized by FY25 in 3 years or FY26? What's the base case expectation that we are having?
So we're looking at FY23 towards the end of FY23 to fully utilize the plants. That's because we have products already lined up for it. They're already being filed the DMF. The customers have already taken trial quantities, and these are just ramping up the volumes, many of them, yeah.
Sure. And for any of this capex that we have done, do we have any take-or-pay kind of arrangement, or is it more of soft indication that products will be lifted and we have plants?
All our plants are multi-purpose plants, so we have multiple products. On the fewer contract manufacturing side, take-or-pay is there, but on the generic side, I mean, you have to have the take-or-pay doesn't exist, but you have customer relationships, existing customers, and we broaden our product base, so the risk on any single customer, any single product is minimized in this case. It is multiple products, so we can move products around.
Sure. And any capex to be done after this particular capex is done at the end of this year, FY21? FY22-23, do you anticipate further capexes, or then it will be more of steadying and only maintenance capex?
See, it all depends on the opportunities. I mean, there's a lot of talk of manufacturing moving from China to India. You must have seen government of India also incentivizing the pharma industry in a big way. That policy is being written up. It's expected to be launched early next month. We are seeing a lot of opportunities, and we'll take them on a case-to-case basis. If there's an opportunity that really demands capex, I mean, we'll really look at that and we'll consider that. As of now, this is what we're doing. There's nothing new planned, but if an opportunity presents itself, we won't shy away from it.
Sure. I'll come back in the queue.
Sure.
Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Thanks for the opportunity. So you have given the export breakup.
Sorry to interrupt you, Mr. Nagraj. We can't hear you very clearly, sir.
Hello. Is it better now?
Yes.
This is better. Thank you.
Yeah. So you have given the crop protection segmentation between exports and domestic. Could you give the same for pharma and for overall for this year? How has been the exports and domestic business split up in terms of rupees?
Yeah, so pharma is mostly exports. I mean, domestic business is a very, very small percentage. And it's about US is about 45 to 50%. Europe is about 20 odd percent. Japan is approximately 10% and growing rapidly. And the balance is the rest of the world, Southeast Asia, Latin America, Central America is about 20%. But our plan is to grow our domestic business in both our divisions because we're seeing a lot of opportunities in the domestic side. And some of our new molecules that we've launched, especially the diabetes portfolio, on the pharma side, have a big market in India. So we'll be launching them in India shortly.
Okay, and out of our 1,500 crores revenue for FY20, how much would be exports and how much would be domestic?
Export was about 80% total, and domestic was close to 20%.
Okay. And in terms of molecules, so currently, how many molecules do we have in both pharma and crop protection? And how it has changed over the last 3 years? So there must be some tail cutting of some of the molecules and the new molecules that have got added. So how it has changed over the last 3 years?
So currently in pharma, we have about 9 to 10 products in the custom manufacturing side and about 14 to 15 on the proprietary side. Every year we add a few. I mean, net addition is 1 or 2 in the CRAMS and 1 or 2 in proprietary every year. I mean, some tail products are removed. But, we don't try and do too many products. We try and do a few, but we try and be market leaders in those molecules. So it's not that we have 50 molecules and, we have only limited products, but we try and be number 1 and number 2 in the world in those products.
Right. And same for CP, crop protection?
So on crop protection, we have about 11 to 12 major products in the CRAMS side and 5 to 6 on the proprietary owned products side. Again, we're adding a couple of CRAM products every year and maybe 1 or 2 proprietary products every year. That's been the change.
All right. Thank you, sir. Yeah. Thank you so much. And best of luck.
Thank you. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hello, sir. Sir, if I look at the gross margin in our business, in FY20, our gross margin has substantially improved compared to FY19. What would you say the reason for the same is?
Well, product mix, we concentrate on product mix, especially in Q4. I mean, if you notice, in spite of having lower sales, the EBITDA margins actually improved in Q4. So we're concentrating on product mix for the year.
Right. And sir, second question is more on the strategy side. I mean, if you look at the top in terms of a lot of companies are getting a lot of inquiries from European suppliers and Japanese end users for shifting some portion of the products to India. I mean, this is the time for us to utilize the capex that we have done over so much years. And, after very soft revenue growth for last 2 years, do you see this year as the inflection point for us for rapid revenue growth over next 1 or 2 years?
Well, the number of inquiries have definitely increased considerably in the last few months. And you're right. I mean, there's been a number of inquiries are coming, and we are having a good manufacturing footprint with environmental clearances in place is definitely a very big positive for us. And we'll be able to utilize our capex for more higher margin products. So we're going to also relook at taking out some older products, replacing our current product portfolio with higher margin products. So that the emphasis will be on margins and improving return on capital employed and cash flows going forward, which we are quite confident that we can do with the new products.
Right. And just last question. In the AGM, you had mentioned that we should be able to do 2,500 crore revenue by FY22. Now, do you see that happening at least by FY23?
Yeah, I think realistically there's about a 1 year delay as of now. So Yeah.
Okay. Thank you.
Yeah.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Sir, my first question is about this margin. Of course, the gross margin improvement we have seen in last year, but what I observe is that gross margin doesn't go down, and our EBITDA margins, we are not seeing the improvement. So your gross margins are up by almost about 2.5 percentage points, but our EBITDA margins are either similar or in fact they are down by 0.5% compared to March 18 and March 19 both. So where is the challenge in terms of the better gross margin not being able to percolate down to our EBITDA margins? And you mentioned that coming year we can see, because of product mix changes, because of better product profile. So can we see a margin improvement in this current year FY21, and to what extent?
Well, I think the reason why the gross margins are not focused down to the EBITDA margin, the fixed costs have remained the same. I mean, in spite of lower sales. So that's been the reason why the EBITDA has gone down in percentage terms. Especially Q4, if you look like. And Q2, we had a major reduction in sales for the reasons already mentioned and explained. But the fixed cost was fixed. For the newer, sorry, I can't hear you. There's a lot of disturbance. Hello?
Hello? Yeah?
Yeah.
I would request Mr. Jain to mute yourself while the management is giving the answer,
okay.
please.
Okay.
Thank you.
Going forward, I mean, the margins are expected to improve. The new launches will have a better margin profile. So and that, along with the operational efficiency measures that we've implemented, we are quite confident that our margins will start improving from this year onwards.
Sure. So can we see a 100 to 200 bits improvement this year? Is that possible?
I think with the current situation, I don't want to give any guidance for the current financial year. There's a lot of fluidity, a lot of uncertainty in the external environment, and it's got to be prudent. A better picture probably the next few quarters, how the things are looking on. Yeah.
Sure. And sir, on the pharma side, if you could just share some details on the volume and pricing part, because we have had a degrowth in pharma segment, and how much of it could be due to pricing and how much of it could be due to volume?
So volume growth was about 6 to 7%, and price increases were about 1%. So net was about 5% reduction. Yeah, if you look at the net reduction, approximately. I'm just giving you a ballpark number.
And have we lost any client on the pharma side?
Not at all.
Sure. Mm-hmm. And sir, with regards to Bangalore capex you mentioned Bangalore capex got over in the second half. I understand the kind of situation which we are into, but and plus by this year end you mentioned we have completed capex for about 160 crores. So typically, what could that lead to in terms of our revenue growth? I'm not able to basically comprehend, because we thought on chemical and pharma probably things are much better compared to some of the other businesses. So still not able to gauge FY21, can we have some kind of single digit growth in our top line, yes or no? So especially given that capex is being done, 160 crores of capex is done. And also one more factor, last year in our Q2, we had lost sales due to flooding at Taloja and also inventory destocking. And that time we had mentioned in Q2 call that some of it will be recouped in, the second half. But we have not been able to see that in terms of that recoupment. And plus, going ahead also, we are not able to, be confident about or have certain degree of probability in terms of top line growth. So I am a bit confused, or I am not able to really understand this.
So your question is, can you repeat, what is your question exactly?
So what I'm trying to say is, in terms of top line growth,
yes,
we have completed 160 crores of capex.
It is WIP. It is work in progress. It is not completed capex.
Okay.
And you mentioned
these are multiple plants being done in multiple sites.
Mm-hmm.
They all work in progress. Some are infrastructure related capex, some are growth capexes. They were all supposed to get done by end of quarter 2, early quarter 3. That was the original plan. But because of this COVID situation, we've lost about 3 to 4 months because of this.
so it is not block by block completion of capex.
No, we do it multiple sites, right? Everything is WIP. It's a work in progress.
Okay.
Mm-hmm.
We always said that this capex was being implemented over 12 to 18 months, even in the last call.
Right. I know that. Yeah. I thought maybe some part of it is, and maybe a block is ready. So it related to basically top line growth only. In this year, current year, we faced an abnormal situation in terms of flooding in one of our plants, and because of which we lost certain amount of business and also inventory destocking. And post quarter 2 con call, in quarter 2 con call, we had mentioned that some of it will be able to recoup, which is not visible, sir, in this current year.
In quarter 3, we did have some recoupment, but in quarter 4, unfortunately, we lost sales because of the COVID situation. So I think if we didn't have the COVID situation, you would have seen this recoupment of quarter 2 reduction.
Okay. Thank you so much. In case of there are further questions, I'll come back.
Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique Asset Management. Please go ahead.
Thank you. Thank you for the opportunity. So my question is, we hear a lot about this India manufacturing, outsourcing, China issues, second source, and you being in this field since very long, working for MNC since 10 years. Can you give a little larger picture? What is actually this story we are hearing, or on the ground things are happening, or actual fact finding?
Well, I think a lot of good things are being said. The implementation on the ground has to happen. I'll just leave it at that. Yeah. At the ground.
Clients inquiry you are getting that because you are since long with so many MNCs. So are you getting more inquiries from number of products, something like that?
No, we are for sure. We are getting inquiries.
Okay. So the second is related to this 15 crore exceptional expense. I think we were telling that we'll be able to maybe reimburse from our customers. So what is the status now?
So part of it has been taken care of through increased volumes, but part will be taken care of this year. We are getting additional demand from the customers to make up for this impact in volumes. Yeah.
Right. Okay. And sir, balance sheet shows some 60 right of use assets, 66 crore. What exactly is this?
Yeah, I'll just hand this over to my finance guy. Let him answer this.
Please.
If you can take this question, please.
Hello.
I would request you to please unmute yourself from your handset, sir.
Yeah, I'm sorry.
Yeah.
So we have adopted 116, accounting standard 116 from this year.
Mm-hmm.
Under this standard, we have to classify the leasehold land as a right to use assets. So this is nothing. This is just a classification from the normal block assets to right to use assets.
Okay, so it's a lease asset which we may be using.
Land we have, we have land from MIDC, especially in Maharashtra.
Right.
Yes, at least we classify it as a right to use.
Correct.
Nothing else, I mean. There is no change.
Thank you. Thanks a lot. Thank you very much.
Thank you. The next question is from the line of Sajal Kapoor, an individual investor. Please go ahead.
Oh, hi. Thanks for taking my question. So firstly, roughly 38% of our consolidated sales are from generics, right? And the rest 62% comes from custom synthesis or contract manufacturing. So 50% is pharma in that and 80% crop protection. That's all actually innovator CDMO. Now, given our blended operating margins are only at 18%, and I know some of the other participants have been were asking this question as well, I'm just trying to get the math correct here. So the generics business seems more like a pure commodity with very low margins, because that's kind of dragging the CDMO margins lower, and we get a consolidated figure of 18%, because my assumption is that on the innovator CDMO, you will not be making anything less than 25%. I mean, the competitors like Suven and Divi's are closer to 35-40%.
So is there a question there?
Yeah. So I'm just trying to understand, is the generics, I mean, what sort of margins we are making on the generic side, because majority of our business, so if I do a 1,500 crore split of the pie, I think 936 or somewhere in that region is innovator synthesis, CDMO that is, and that must be 25% plus sort of margin. But on the consolidated side, the margins are only 18%. Which means that the generics business is pure commodity with very low margins, because that's kind of resulting in a blended margin of 18%, despite the fact that the custom synthesis on the innovator side is a higher margin business. So if you could just help us out, please.
Yeah, I think you're right. Custom manufacturing business does have a better margin profile than the generics. But as a company, we don't give the numbers of what margins we make on both the divisions, both parts of the businesses. But we have some older molecules that do have a lower margin, so we're replacing that with newer margin products, higher margin generics also, which are being launched. So the margin profile will change going forward.
Yeah, but currently I think it's somewhere, because it's easy to do that, 900 plus sales giving 22, 23, maybe 25% margins, and the other half, which is the generic, is going somewhere in the region of 8 to 10% margin at max. So, yeah, I mean, we appreciate that maybe 3 to 5 years down the road, we may be getting over 20%, but I just wanted to get your sense that, there's some of the gabapentin maybe, and maybe some of the older molecules, they are just pure commodity APIs. They may not be fetching more than 8-10%, but that's my understanding. Anyway, and secondly, I mean, would it be possible to share the pipeline on the innovators, so number of molecules, not the names or the customers, but in terms of the number of molecules that, how many we have on the phase 3, phase 2, preclinical, that sort of split, because some of the other companies do share that, and it kind of gives us a lead indicator in terms of what to expect over the next 2-3 years. But in our case, in case of Hikal, we don't get that visibility, so we don't know how many projects are there in phase 3, phase 2, and so on.
Yeah, thanks. I'll hand this over to our head of new business development. Anish, if you can take this.
Yeah, sure. Thanks, Amir. So we have a pipeline in both our divisions. In the pharma division, we have a mix of products that we have under our pipeline or contract development. There are basically anywhere between 4 to 5 products at any given time in our CDMO division. I'd say none of these are finished APIs. They're all early stage products. So I'd say majority of the 4 to 5, there are about 3 in the phase 2 type, 2A, 2B, and about 1 in phase 3. Now, these are, again, intermediates, some of which go into multiple products. So it's a little challenging to kind of forward and tell you, what is going to be the potential. But this is really where the pipeline is.
So 4 to 5 in phase 2 is stroke early phase 3. That's all we have on the innovator synthesis pipeline, right?
That's correct. Okay. And these are, again, intermediates, that go in. Sometimes in most of these products, we don't even know what the final usage is going to be, because they're all coded, and then they're building blocks that go into other products.
Understood. And very finally, sir, a housekeeping. So all emails that I send to strategic growth advisors, they go in some sort of a black hole. I never receive any response despite reminders. And I've been sending emails. I never get any response to the strategic growth advisor. I know they are on the call, and that's the reason I'm raising it. Thank you.
Okay, we'll take note of that, and I'll ensure that the representative from there calls you or gets in touch with you so we can answer your questions.
Thank you so much. Thank you.
Pleasure.
Thank you. The next question is from the line of Anupam Agarwal from Lucky Investment Managers. Please go ahead.
Yeah, good evening, everybody. Thank you for the opportunity. Sir, my question is if you could just repeat the volume and the price growth for the year across both divisions.
Sorry, I said volume was about 6 to 7% lower.
Okay.
Because and price was about 1% higher.
This split is more or less same across both the divisions?
It's an average across both the divisions.
Okay. And sir, on the COVID, on the top line, what sort of sales we must have either deferred or lost in the last 15 days of the COVID situation?
So in Q4, we lost around 50 crores.
And is this deferred to Q1? Have we booked the sales here or?
So most partly it will be taken care of in Q1 and partly in Q2. They're not losing the sales, it's been deferred. The sales have not been lost.
So it's already booked in Q1 or?
Part of it, a majority of it, and some remaining will go into Q2.
Okay.
Because some of our customers have not started up fully in April, May. They're just starting up operations now. So they also have capacity constraints. So they've taken most of it.
Right.
And some will carry forward to Q2. But there's no loss in absolute revenue. They just be deferred by 1 quarter.
Right. And sir, on the product pipeline, we understood the pharma side of it. Can you explain this on the crop protection side as well?
Sure.
So on the crop protection side, we have 2 to 3 products in the CDMO pipeline, and in addition to which we have at any given time we work on 1 to 2 of our own proprietary products. So that's the current pipeline that we have.
Could you quantify the size of the total pie, or is it?
So at this point in time, they're all early stage projects. So we work with various global innovators both across Europe and Japan and the US. So some are in initial stages of evaluation. These products are in what I would call where we give the samples to the clients working on process development, and eventually they go. The crop protection business differs from the pharma business in the sense that, once you do commercialize or you do get a product, it takes a long time to commercialize because registration is country by country. It's not pan-European as in the case of pharma. But, at any given time, we ensure that there is a pipeline of products or projects that are about 2 to 3 on the CDMO side and about 1 to 2 on our own proprietary side.
All right. Again, last question, if I may. So what is the plan on our debt reduction? If you could just give us a strategic pathway as to see, because on a debt equity we are comfortable at 0.2, 0.3 times, but to quantify that debt to EBITDA is slightly more on the higher side on 2.5 times. So are we comfortable there, or do we have some plan on debt reduction?
Yeah, so I think our equity, our ratios have improved year on year. If you look at the company going back 10 years, we had more or less the same amount of debt as we have today, right? But we're about 2.5 times bigger than where we are. We are in the capex phase. So we are continuously investing all the money that we have, or a significant amount of the money that we generate back into the assets of the company so that we can grow. The growth assets that we're putting into place are obviously going to be higher margin products that we have here. So that run rate that we generate with the new products, the new investments that we do will help us pay back the debt. But again, this is a very high intensive capex type of business. Again, if you don't invest like today, if we, as Samir has talked about the China opportunity, we definitely do see an opportunity coming. We've seen the traces of it from customer inquiries. We're also seeing possibly a macro shift that will happen. It won't happen over the next 6-12 months, but maybe over a bit of a longer period, 18-24 months, because it's not possible to just change your supply chain overnight. So in order to capitalize on that, you definitely have to have assets on the ground available. And these have to be, to a certain extent, free assets, because companies don't wait, right? So we continuously juggle around to see what the best mix of filling our assets are. And also there are spot opportunities that we do get. So for example, like for Fevikwik, it was a spot opportunity that came. We developed the product very fast, and now we're fitting it in our existing manufacturing assets as well. So we'll continue to invest. We'll continue to pay back the debt. We have an excellent track record with our bankers, and our debt rates have also come down significantly.
And working capital sustainability, are we comfortable at 110, 100 days also, or?
Yes, I mean, given the current situation, of course, that might fluctuate up and down, but consistently over the last 2 years, we've brought down the working capital cycle. Obviously, now the situation is changed in the sense that, people are asking us to maintain more stock. We ourselves are looking at safety stock situations because just-in-time inventory is probably gone in today's environment. Will it be gone forever? Probably not, but the next 12 to 14 months, we'll be watching this very closely. We have norms in place, but our focus is going to be on making sure that we ensure delivery to our customers. Supply chain security is going to be the number one focus of the company.
Right. All the best for the future, and that's all from my side. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the follow-up. So one clarification. You indicated that FY23 will be full utilization for our incremental 300 crores CapEx. So that year we expect about 400 to 450 crores of revenues. Is that assumption right?
Part of that CapEx also includes some infrastructure CapEx, so you can take some of that out.
Right. Okay. And when you said that you want to expand into domestic, arena, so currently pharma is 100% exports and crop protection 20%. So what's the strategy here, and what are the segments that we are targeting here?
So on the crop side, our biocide business, we already have a presence in India. We're also getting registration for some crop protection products in India, where we're seeing molecules that were typically imported from China in the past. There's a domestic demand. So we're launching some active ingredients in the domestic market in next year. By end of this year, we should have the registration in place. Pharma, again, our presence domestically has been negligible, but we're seeing opportunities on the cardiovascular side and on the diabetes portfolio that we have filed. And we expect to increase our presence in the domestic market. Again, if we're looking at niche opportunities in India, and some of the new molecules that we'll be launching in the country.
Right. And in terms of expansion after 2023, what is the strategy in terms of the land bank? Do we have sufficient land bank for further brownfield expansion, or we'll have to go in for some new areas?
So in Bangalore side and our Panoli side, we have almost 40-50% additional land available to grow. So I don't see any requirement for the next 4 to 5 years from land requirement. We are covered right now.
Okay, and just one last question on the sourcing front. So currently, what is the sourcing from China, and what do you expect probably to reduce it over the next 1 year? Because you said in your opening remarks that we are scouting for domestic sourcing of key raw materials.
So currently, we are buying about 35 to 40% of our total procurement comes from China. So we've already started the process even before the COVID to de-risk China and to move to domestic manufacturing. And we expect this to come down to 20 to 25% in the next 1 year, and even towards 20% in the next 2 years. That's our target. Some products you still have to buy from China, but we have multiple suppliers in China also. And but we'll bring it down. Eventually, aim to bring it about 20% the next 18 to 24 months.
All right. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Mr. Sunil Hiramat for closing comments.
Just one second.
Ladies and gentlemen, due to time constraints, yes, so you may go ahead, please.
Yeah. I'd like to take this opportunity to thank everybody for joining the call. I hope we have been able to address all of your queries. For any further information, kindly get in touch with Strategic Growth Advisors, our Investor Relations Advisors. Thank you once again. Please stay safe and stay healthy. And have a very good evening. Thank you very much.